Most silver holders have absolutely no idea what is coming next. Not because they are unintelligent, and not because they lack access to information, but because they misunderstand the nature of the metal they hold. Silver is not simply a commodity. It is not merely an industrial input, and it certainly does not behave like most financial assets people are accustomed to watching on their screens every day. Silver lives at the intersection of money, industry, speculation, and psychology. When those four forces collide, the result is rarely calm and rarely predictable. Yet the pattern repeats over and over through history. For most of the time, silver moves quietly. It drifts sideways. It frustrates its holders. It convinces people that nothing will ever happen. The market grows bored. Investors move on to whatever trend is fashionable at the moment. Technology stocks, real estate bubbles, cryptocurrency manias, artificial intelligence narratives. Meanwhile, silver sits silently, ignored and often ridiculed. In those quiet periods, something very important is happening beneath the surface. Ownership transfers from impatient hands to patient ones. Weak holders exit. Strong hands accumulate. The market compresses like a spring. Eventually that spring releases. When it does, the move is rarely gradual. Silver does not climb politely. It explodes. Most people who currently own silver are mentally prepared for a slow appreciation. They imagine a steady climb of a few dollars per year. They imagine orderly markets and rational price discovery. That is not how silver behaves when the environment shifts. When conditions align, silver can move in months, what normally takes other assets a decade. The reason for this volatility is simple. The silver market is extremely small relative to global capital flows. The amount of investment capital needed to dramatically move the price is shockingly tiny compared to the trillions circulating through global financial markets. When generalist investors begin allocating even a small percentage of their portfolios toward precious metals, the price impact becomes explosive. At first, the movement is led by gold. Gold is the metal of caution. It is the first destination when investors begin questioning the stability of currency systems. Gold represents safety, stability, and wealth preservation. When uncertainty rises, institutions move into gold quietly. Silver follows later. Silver is the metal of acceleration. When confidence in the bull market grows and investors begin seeking higher returns, capital rotates from gold into silver. That is when things begin to move much faster. Silver historically outperforms gold dramatically during the later stages of precious metals bull markets. It is not unusual to see silver move 2, 3, or even 5 times faster than gold in percentage terms. But this phase catches most investors completely unprepared. People buy silver because they believe it is cheap. They buy it because someone told them it might double someday. They buy a few coins, place them in a drawer, and forget about them. They do not understand the macroeconomic forces building beneath the surface. They do not understand the structural supply constraints. They do not understand the monetary implications of a world drowning in debt. And they certainly do not understand how quickly sentiment can change when the broader investment community finally begins paying attention. Right now, we are witnessing the early stages of that transition. For years, silver was dismissed. Analysts ignored it. Media coverage was minimal. Financial television rarely discussed it, except in passing. Investors preferred growth stocks, high-yield bonds, speculative technology companies, and other assets that seemed exciting in the moment. But markets move in cycles. The cycle that favored financial assets above all else is beginning to weaken. Rising debt burdens, inflationary pressures, geopolitical instability, and monetary expansion are forcing investors to reconsider the role of hard assets in a portfolio. Slowly, almost reluctantly, capital is beginning to move back toward tangible stores of value. Gold is receiving the first wave of that attention. Silver will receive the second. Most silver holders are not mentally prepared for what happens when that second wave arrives. They imagine that if silver rises significantly, they will calmly hold their position and watch their wealth grow. In reality, the psychological pressure becomes intense. Rapid price increases create emotional turbulence. Every day brings larger swings. News headlines begin appearing everywhere. Social media becomes obsessed with the metal. Suddenly everyone seems to have an opinion. This is when inexperienced investors begin making mistakes. They sell too early because the profit feels unreal. Or they panic during temporary corrections and abandon positions just before the next explosive move. Or they become greedy and chase speculative mining stocks without understanding the risks involved. The silver market punishes emotional decision-making more brutally than almost any other asset class. Understanding this behavior is critical, because the real opportunity in silver does not come from predicting the exact price. The opportunity comes from understanding the structure of the cycle itself. Every precious metals bull market follows a similar progression. The first phase is disbelief. During this stage, prices begin rising quietly while the majority of investors remain skeptical. Analysts call the move temporary. Commentators attribute it to short-term events. Very few people believe the trend will continue. The second phase is recognition. More investors notice the sustained movement and begin allocating capital. Institutional interest grows. Financial media begins discussing the sector more frequently. Price momentum accelerates. The third phase is enthusiasm. At this stage, participation expands dramatically. Retail investors enter the market. Exchange-traded funds attract massive inflows. Mining companies receive large valuations. Exploration activity surges. Prices move rapidly. The final phase is mania. Speculation becomes widespread. New investors rush in without understanding the fundamentals. Price increases appear almost daily. Valuations detach from reality. Silver historically performs its most dramatic moves during the transition between recognition and enthusiasm. That is the moment when capital flows into the market faster than supply can respond. And this is where the structural nature of the silver market becomes extremely important. Unlike many industrial commodities, silver production cannot quickly expand when prices rise. A large percentage of global silver supply is produced as a byproduct of mining other metals, such as copper, lead, and zinc. This means that even if silver prices increase dramatically, primary production does not immediately surge. Mining companies cannot simply flip a switch and produce more silver. Supply remains constrained. At the same time, demand is expanding. Silver is used in electronics, solar panels, medical technology, electrical systems, and hundreds of industrial applications. As global technology infrastructure expands, silver consumption increases steadily. Add investment demand on top of that industrial demand, and the balance becomes extremely tight. When both forces collide, limited supply and accelerating investment demand, the price response can be extraordinary. History shows this pattern repeatedly. During previous cycles, silver moved several 100% in relatively short periods of time. Those moves did not occur because of a single news event or a temporary shortage. They occurred because a structural imbalance developed between available supply and sudden investor demand. Once that imbalance appears, the market begins repricing the metal very quickly. Most investors do not understand how thin the physical market actually is. A relatively small surge of institutional capital can absorb months of global production. When large funds, pension managers, and asset allocators decide to increase exposure to precious metals even slightly, the ripple effects become massive. This is why the psychology of the market changes so quickly once momentum begins. At first the movement is ignored, then it is questioned, then suddenly it is chased. And that is when the real volatility begins. Many silver holders today believe they are prepared for higher prices, but they have never experienced the emotional intensity of a full precious metals bull market. They have never watched the price jump $5 in a single week. They have never seen mining stocks double in months. They have never witnessed the sudden explosion of public interest that occurs when mainstream investors finally realize what is happening. When that moment arrives, the market environment transforms. Articles appear everywhere discussing silver shortages. Financial networks invite analysts to debate the future of precious metals. Influencers begin promoting silver as the opportunity of the decade. Coin dealers report record demand. Physical inventory tightens. Premiums expand. What began as a quiet accumulation phase becomes a global conversation. This transition is exactly what most silver holders are not expecting. They assume that if silver ever rises significantly, it will be a gradual process unfolding over many years. But markets rarely behave that politely when structural imbalances are involved. When the pressure builds long enough, the release can be violent. And once the move begins, it tends to feed on itself. Rising prices attract attention. Attention attracts capital. Capital pushes prices higher. Higher prices generate headlines. Headlines attract even more participants. Momentum becomes self-reinforcing. This feedback loop continues until eventually speculation overwhelms fundamentals. That is the stage where caution becomes necessary. But long before that moment arrives, the market typically passes through a period where silver holders experience gains they never expected to see in such a short time frame. Understanding that dynamic is essential because it determines how investors should mentally prepare for what lies ahead. Silver is not an asset that rewards constant trading. It rewards patience during the quiet phases and discipline during the explosive phases. Investors who accumulate during periods of indifference often benefit the most when sentiment shifts. But patience requires conviction. And conviction requires understanding the forces shaping the global financial environment today. Across the world, monetary systems are under extraordinary strain. Governments carry unprecedented debt loads. Central banks continue expanding balance sheets. Inflation periodically surges, even when policymakers attempt to suppress it. These conditions historically favor tangible assets over financial promises. Gold reacts first because it has thousands of years of monetary history behind it. Central banks themselves hold gold as a reserve asset. Institutions trust it. It moves steadily when currency confidence weakens. Silver follows with far greater volatility because it sits between two worlds, monetary demand and industrial demand. That dual identity creates enormous leverage during certain economic environments. When investment demand rises at the same time, industrial demand remains strong, the available supply becomes increasingly tight. Prices must rise to balance the market. Most silver holders today are focusing only on the price they see on a chart. They are not paying attention to the underlying shift taking place in global capital allocation. They are not noticing the quiet accumulation occurring among investors who understand the cycle, and because of that, they may be psychologically unprepared for the speed of the move when it arrives. The next phase of the precious metal cycle will not be defined by slow appreciation. It will be defined by sudden recognition. Recognition that silver is dramatically smaller than most investors realize. Recognition that supply cannot rapidly expand. Recognition that monetary instability increases demand for tangible stores of value. Recognition that capital flows into the sector can overwhelm the existing market structure. When those realizations spread across the investment world, silver will no longer be ignored. It will become impossible to ignore. And when that happens, the majority of current silver holders may find themselves watching one of the most powerful moves in the entire commodity space unfolding far faster than they ever imagined. But the story does not end there, because what happens after that first surge is where the real transformation of the market begins. By the time most investors realize something extraordinary is happening in silver, the majority of the move is already underway. That is one of the defining characteristics of this market. It does not politely signal its intentions months in advance. It stays quiet, almost boring, until suddenly the narrative shifts and the price begins accelerating faster than anyone expected. At first the move feels temporary. Analysts search for simple explanations. Some blame short-term industrial demand. Others mention currency fluctuations. Commentators attempt to frame the rise as a brief reaction to a specific news event. Very few people are willing to admit that a structural shift might be unfolding, but the deeper reality is rarely visible on the surface. For decades, the global financial system has been built on expanding layers of debt. Governments borrow to fund spending. Corporations borrow to fund expansion. Consumers borrow to fund lifestyles. The entire structure functions as long as confidence remains intact and liquidity continues flowing through the system. When confidence begins to weaken, investors start looking for assets that exist outside that debt structure. That is where precious metals enter the conversation. Gold usually attracts the earliest wave of capital because it is widely recognized as a monetary asset. Institutions understand it. Central banks hold it. It represents stability during uncertain periods. Silver, however, becomes the focus once investors begin searching for leverage within the precious metals space. And silver has a unique ability to provide that leverage. Because the market is so small compared to global financial assets, relatively modest capital inflows can move the price dramatically. A shift of even a fraction of institutional portfolios towards silver can absorb enormous amounts of available supply. Most people underestimate just how small this market truly is. The total value of investable silver above ground is tiny when compared to the size of global equity markets, bond markets, and derivatives markets. Trillions of dollars circulate through those systems daily. The silver market, by comparison, is almost microscopic. When capital begins moving from large pools of money into a market this small, the effect can be explosive. But the story becomes even more interesting when you consider the supply side of the equation. Silver production does not expand easily or quickly. Much of the world's silver is produced as a byproduct of mining other metals. This means the supply of silver is often tied to the economics of entirely different commodities. If copper or lead production slows, silver supply can shrink even if silver prices themselves are rising. This creates a strange situation where demand can increase rapidly while supply remains stubbornly limited. Industrial demand continues absorbing large portions of annual production. Technology manufacturing uses silver extensively because of its unique conductive properties. Electronics, solar panels, advanced batteries, medical instruments, and numerous other applications depend on it. At the same time, investment demand can surge when economic uncertainty grows. Those two forces operating together create a powerful pressure on the available supply. For a long time, that pressure may remain hidden. Inventories appear sufficient. The market seems stable. Prices move gradually. Then something changes. A shift in investor psychology begins drawing larger flows of capital toward tangible assets. Inflation concerns intensify, currency confidence weakens, geopolitical tensions remind investors that financial systems are more fragile than they appear. Suddenly, the quiet silver market finds itself facing a wave of attention. Investment funds begin increasing their allocations. Retail demand expands rapidly. Physical metal starts disappearing from dealer inventories faster than it can be replenished. Premiums widen. Futures markets become more volatile. Price movements grow larger and more frequent. This is the stage where many silver holders start feeling both excitement and anxiety at the same time. Watching the value of an asset rise quickly can be thrilling, but it can also be psychologically overwhelming. Large price swings test discipline. A sudden drop of several dollars can trigger fear, even when the broader trend remains intact. A sharp rally can trigger greed, tempting investors to chase speculative opportunities without understanding the risks. Maintaining clarity during these periods becomes extremely difficult. But those who understand the nature of the cycle recognize that volatility is not a sign of weakness in the silver market. It is a symptom of expanding participation. When new investors enter a small market quickly, price discovery becomes chaotic. Buyers compete aggressively for available supply. Sellers hesitate, wondering if higher prices are coming tomorrow. This tug-of-war produces dramatic price movements. The most important thing to understand is that these movements are often only the beginning of a much larger trend. Because once the financial media fully discovers silver, the narrative begins spreading rapidly across the investment world. Articles appear discussing potential shortages. Analysts begin projecting dramatically higher prices. Social media fills with discussions about precious metals. The metal that spent years being ignored suddenly becomes a topic of daily conversation. This is the moment when institutional money begins taking the market seriously. Large funds rarely move first in commodity bull markets. They wait for confirmation, they observe trends quietly, but once they decide to allocate capital, their size alone can move markets. When even a small percentage of those funds begins flowing into silver, the impact becomes impossible to ignore. The metal starts behaving differently. Daily price changes become larger, momentum builds, mining companies begin reporting stronger earnings. Exploration companies attract funding again. Investors who once dismissed the sector suddenly begin researching it intensely. The entire ecosystem surrounding silver begins waking up, and that awakening can create one of the most dramatic periods of wealth creation in the commodity world. History shows that during powerful precious metal cycles, silver often outperforms nearly every other asset class for a period of time. Not because the metal suddenly became more valuable overnight, but because the market is rapidly correcting years of neglect and underinvestment. Prices move quickly to rebalance supply and demand. During those phases, the gains can feel surreal. Assets that seemed stagnant for years suddenly surge. Mining companies multiply in value. Physical metal becomes increasingly difficult to acquire at posted prices. Investors who accumulated during the quiet years watch the market transform in front of them. Yet even during those extraordinary moments, discipline remains essential. Markets driven by momentum can overshoot just as dramatically as they rise. The same psychology that pushes prices upward can eventually create speculative excess. Understanding where the market sits within the broader cycle becomes crucial. But before that final stage ever arrives, the silver market typically passes through a window of opportunity where the combination of rising demand, constrained supply, and expanding investor awareness produces extraordinary price action. Many current silver holders believe they are simply holding a modest hedge against inflation. What they may actually be holding is a front-row seat to one of the most powerful commodity repricing events that can occur within modern financial markets. Because silver is not just reacting to industrial demand, it is responding to something far bigger, a global reassessment of what constitutes real value in a world increasingly dominated by financial promises, expanding debt, and fragile monetary systems. When that reassessment accelerates, the metals that represent tangible value tend to move first and fastest, and among those metals, silver has always had a unique ability to surprise the market. Not gradually, but suddenly. That is why the coming phase of the cycle may look very different from what most investors currently expect. The quiet years of indifference are ending. Attention is growing. Capital is beginning to move. And once the broader investment world realizes how small the silver market truly is compared to the oceans of capital searching for protection and opportunity, the repricing that follows may unfold faster than almost anyone is prepared for. Most silver holders believe they are simply waiting for a price increase. What they may actually be waiting for is a moment when the entire market finally wakes up to a reality that has been building quietly for years. When that realization spreads through investors, institutions, and financial markets all at once, silver will no longer behave like the slow, forgotten metal many people assume it is today. It will move quickly, unpredictably, and powerfully. And those who understood the cycle before the crowd arrived will find themselves standing in the middle of a shift that most people never saw coming.